Provisional tax for dummies. Now, this is the simplest way we can explain provisional tax for you. Now, provisional tax is you paying tax on the profits that you currently have, and you're provisionally paying them towards what their eventual tax bill is. Now, if we step back for some context, the way that the IRD calculate this is on the prior year, or the last set of data that they have. Because let's not forget, when you're coding your Xero or MYOB, the IRD don't know how you're performing at an income tax level. So what they say is you need to pay us provisional tax based on the prior year, plus normally a 5% uplift. Now, if you're slow to have your accounts done, you could potentially be paying on the prior year plus 10%. Our suggestion is that it's smart to get your accounts done as soon as possible so that you know what your tax situation is. We work with over 100 SMEs all across the country, and they are high-performing businesses and aspirational, growing, learning, and continuing to improve the economy of New Zealand. And one thing that we find is people hate tax surprises. And why this happens is because your accountant isn't keeping you up to date with what your current tax bill is, because you're logging into your MyIR, or they're reminding you, hey, your payment is XYZ based on the prior year, but this year is not the prior year. So what does that mean? If you're not keeping up to date with your coding and your current profitability and keeping your accountant in the loop, they and the IRD are just going to tell you to pay tax based on the prior year. But if you've got unforeseen circumstances, a completely different business, less profit, more profit, you're going to end up with a very different tax bill because every financial year is different. So if we step through an example, let's say there's a business that makes $100,000 of profit. And let's just say, to keep it simple, because this is for dummies, that tax on that is $30,000. Now, we file the set of accounts with the IRD and they say, oh, you made $100,000 profit and you hadn't paid any provisional tax because this was only your first year of making a profit, but now you owe us $30,000 of tax. Beautiful. That becomes terminal tax, which is normally due April the following year. So from there they say, we don't want to run the risk that you can't pay the next lot of lump sum on your profit too, so we want you to pay provisionally that you're going to have the same level of profit. So now we want you to pay $30,000 plus 5%. That would bring us to $31,500. I hope my math is good there. At each installment, they're going to want you to pay $10,500 at the 28th of August, the 15th of January, summertime when cash is tight. That's tough. Make sure you get that one on your calendar, and the 7th of May. So that's what you're going to do. Here's the 10.5, Mr. and Mrs. IRD. Here's another 10.5. Here's another 10.5. And you're going to think, well, I paid all of my tax. Your accountant's going to come along and say, oh, you actually made $200,000 in that financial year. Sorry, we weren't keeping an eye on that. And they do your accounts and they say, oh, sheesh, your tax on that was actually $60,000. Therefore, we've got a $28,500 shortfall on your tax, and that might become liable as terminal tax April the following year again. But this is where you get a surprise and you get frustrated and you think, but you told me I only had to pay 10.5, and the IRD, when I logged into my IR, that said 10.5 as well. What do you mean? So a suggested approach is to keep an eye on your profitability as the year goes. Because as in this example, if you're becoming more profitable, you're going to want to put more money aside for tax so that you're not getting a surprise. Equally, if you're becoming less profitable, you want to let your accountant know, and you might say, you know what, I don't know if I want to pay the entire obligation because that's based on last year, but this year says we're not as profitable. The current financial that you're in will create the true obligation for tax, but the IRD are always basing it on the year before. But provisionally, you're paying so that they don't lose out and you don't squander the money and spend it on ranges, jet skis, and overseas trips in the meantime. That's why they want some of it 3 times throughout the year. Remember, 28th of August for most people, 15th of January, and the 7th of May. Caveat there, if you've got a different balance date to 31st of March, your dates are going to be different, but for most SMEs in New Zealand, it's going to be the 28th of August, the 15th of January, and the 7th of May. You want to have those dates in your calendar, and you want to have a reminder a month out too. What's my obligation? Again, it'd be very smart to put your tax aside into a separate account as you're going throughout the year, so when those dates roll around, you can go, there you go. Now, let's give you a little bit of provisional tax 301. We're skipping 201. What a lot of smart people do is they pay their obligation at August and January based on the prior year, if they're still trading well, and then at the 7th of May, we've already got the full financial year's data. So we should know what that payment should be. Your accountant should be doing that for you. We do that for over 100 SMEs in New Zealand, high-performing, aspirational business owners that need to understand what that final payment is. Is it more? Is it less? And we can basically work out what that final payment should be so that you're keeping it current. The current year will create your final obligation. The provisional, again, is based on the prior year. So that payment might need to be more or it might need to be less. There's plenty of options. Then we get into Provisional Tax 401 where you can start using tax pooling and all sorts. But just start with the basics to start with. That's how provisional tax works. Any questions, let us know. We'll be happy to answer them below in the comments.